The current account deficit was sitting at about 0.7% of GDP in FY24. So the current account deficit is getting bigger and bigger. It is estimated that the RBI nearly sold about $25 billion of reserves. So is it a classic case of a currency crisis? In December 2025, the rupee slipped past the 90 mark. And it had sparked headlines about record lows, currency crisis, and many more things around structural issues with the Indian economy. For anyone who wants to spend dollars, this hurts. If you want to go for a foreign international trip, you're trying to send children abroad for education, you want to buy something from the foreign markets, all of this is becoming more expensive. So is it a classic case of a currency crisis? Or is there something more in the story? Is there a strong demand potentially which is resulting in the currency sort of falling right now? Let's look into it in today's video. So before we move forward, let's understand where India stands. India is still growing fast. Based on the GDP numbers that came out in September, what we saw was around 8.2% real GDP growth, which is amongst the strongest across the globe today. The current account deficit was sitting at about 0.7% of GDP in FY24 before imports picked up, and foreign exchange reserves were roughly around $686 billion. Now, to understand why the rupee is weaker amongst the backdrop of the numbers that we just said, we need to understand what is balance of payments. You can think of balance of payments as a simple concept of money coming in and money going out tracker that India has with the rest of the world. On the daily side, we have the current account. This is where India is buying more from the world than it is selling back to the world. So the current account deficit is getting bigger and bigger, and it has grown from 0.7% of GDP in FY25 to around 1.3% in FY26, and is expected to keep rising roughly to about 1.5% in the coming financial year, which is roughly around $64 billion. Now, the trade deficit within the current account deficit is expected to average roughly around $30 billion by FY26. That means if this part of the equation is left unchecked, it means that more dollars are going out than they're coming in. Now, on the other side, we have the capital account or the investment side. And it's one of the questions that is sort of themed out. Over the past few years, the net foreign direct investment or FDI, that is adding roughly around $40 billion to the balance of payments. Now it has dropped to nearly zero. So when you put the current account and the capital account together, you get a clearer picture. The current account is in deficit, and has weaker support from long-term foreign investments, which also means that it makes India's external position look more unbalanced when we go into 2026, and also explains to some degree why the rupee is under some sort of pressure unless and until the RBI really steps in with its reserves. So let's try to understand both current account and the capital account a bit better. The current account records what India buys and sells to the rest of the world. Every time India imports oil, electronics, machinery, gold, someone sells rupees for foreign currency, that is what the current account is capturing. Every time we are selling or exporting software, drugs, other goods and services, where foreigners are buying rupees, that also gets captured into the current account. So it's a plus and a minus of money that's coming in and money that's going out of the economy. Now, since mid-2024, what we're seeing is that the domestic demand has been very strong. There has been a simplified GST with lower rates and easier compliance, combined with growth that has been coming in for the Indian economy, which is putting more spending power in individuals' hands. And a visible share of that spending has gone into more import-intensive goods, which means that the trade deficit is widening. Gold imports have also risen after the GST cuts, which is adding more pressure to the current account. At the same time, US tariffs is also making it harder to export more items from India. Indian firms have obviously diverted some of their sales from the US market to Europe and Asia and the Middle East to potentially offset the drag that's happening from the US tariff trade issues that have come up. Even if the tariff rate goes from 50% to let's say 25% in early 2026, expectation is that the export growth will likely remain softer than it's been there in the past, which means that the current account deficit will continue to widen as we go forward. Now, let's look at the capital account. Historically, the capital account has been the one that has bridged this gap in terms of the deficit that we see from the current account. And here, we're drawing in foreign investors to invest in Indian assets, to put money in the Indian markets. But today that bridge is narrow. Net FDI, as you spoke about earlier, has fallen from $40 billion to nearly zero, as repatriation has risen and outward investment by Indian firms has also increased. Portfolio flows are mixed, and what we're seeing is even bond flows have improved after the Indian government bonds were announced to be introduced into the JP Morgan Emerging Market Index, but equity flows have been quite choppy. So when FDI taking profit from the Indian markets, repatriation is rising, Rupee tends to sort of weaken with a short lag. This may be because there might be cyclical rather than more permanent issues here, but it still means that the balance of payments is under modest pressure, even if some of the portfolio flows from a bond side might be improving, and unless and until a trade deal also materializes. So given everything that's happening on the current account and the capital account and overall balance of payments, what is the RBI doing? Well, the RBI's foreign exchange operations become key here. Between October to December 2025, it is estimated that the RBI nearly sold about $25 billion of reserves and has built up a sizable short forward position in the USD INR levels around 88 to now 90. So when the rupee comes under pressure, the RBI is stepping in to smoothen any of the volatility. It's selling dollars, it's discouraging speculative positions in the market. The central government has signaled that fundamentals is what is going to sort of put pressure for the rupee to weaken, and it will eventually allow the USD INR to stay above 90 as part of sort of ongoing orderly adjustments from the market supply and demand. When we look at implied FX volatility and any risk reversal measures, which are showing whether traders are paying more for protection against a further sharp fall in the rupee, it shows that it's more or less contained. So from a market perspective, there isn't a sentiment or a behavior that there is a fear of a crash coming up in the rupee. Now RBI has also cut the repo rate by about 25 basis points to around 5.25% and is expecting to end the easing cycle and announcing any further liquidity support through government bond purchases and a 3-year FX swap worth about $5 billion. Together, when you put all of these liquidity measures and easing cycle, etc., we're expecting around 1.4 trillion rupees to be injected into the system, which means there should be more easier funding conditions. So RBI's policy is now set to support growth and credit through encouraging a disorderly exit from rupee assets. The RBI's communication continues to focus on managing the volatility on the exchange rate as opposed to defending a specific rate or a level that they want to have the foreign currency at. So what's next for the rupee? Well, when you look ahead, the base case here is that the rupee continues being soft, but the backdrop here is of obviously strong growth for the Indian economy and potentially manageable inflation rather than any real crisis coming up right now. So what's next for the rupee? Looking ahead, the base case is one of continued softness in the rupee, but the backdrop of all of this is that there is a strong growth for the Indian economy. Inflation is manageable right now. RBI has significantly large FX reserves. We are getting more access to the foreign global bond markets, which could improve flows into the economy, and the central bank's credibility remains intact as of now. There is also a reform story here where the RBI and the government has enacted several structural measures in the wake of the external tariff shock that we've seen from the US markets. In the near term, when we look at all of these structural reforms and price for a stronger growth scenario, there could be wider current account deficits and a softer net FDI potentially. That is why we're seeing this sort of a weaker rupee. But India is entering all of this with a strong growth at around 7%, very low inflation. FX is at very low sort of valuations right now on a real effective basis, and a reform agenda that can potentially lift productivity and attract new capital over time. So the real story here is that the currency is actually just adjusting to fundamentals, and the central bank is actively monitoring the situation, and overall the economy is looking quite resilient based on the numbers that we've seen. We hope you enjoyed today's video and you understood what is happening with the Indian currency markets. Do like, share and subscribe. Let us know in the comments what else you want us to cover next. Till then, happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.